April Fool's Day. The one day of the year where everyone expects to be tricked, where every headline gets a second look, where you question everything because you know someone somewhere is trying to make you look stupid. And I need you to carry that exact same energy into the silver market today, because what is happening in the COMEX right now on Wednesday, April 1st, 2026 is the biggest trick of the year. But the trick is not a joke. The trick is a strategy, a documented, repeatable, financially motivated strategy that commercial banks have executed at the start of every major delivery cycle for the last 14 months. And if you fall for it today, if you sell your silver into this morning's price action, if you panic at whatever red candle they manufacture between 9:45 and 10:45 a.m. Eastern, you are going to miss the real move that comes after the joke. Let me explain exactly what the trick is, exactly who is running it, exactly why today is their best opportunity, and exactly what the data says happens in the days and weeks after they execute it. Because the pattern is not hidden. It is sitting in the CME delivery reports, in the CFTC commitments of traders' filings, in the vault inventory data, and in the price action timestamps from every first notice day window since October 2025. 6 consecutive FND windows, 6 consecutive pre-delivery smash attempts, and in every single instance, the price recovered within 48 to 72 hours, every single one. The trick works like this. Today is April 1st. The April delivery cycle opened Monday, March 30th. The first confirmed delivery notices are being processed right now. 9.9 million ounces are standing for physical delivery. The COMEX registered vault holds approximately 76 million ounces and has lost 38% since October. The coverage ratio sits at 13.5%, below the 15% stress threshold for the first time in modern exchange history. Commercial shorts hold 45,444 contracts, representing approximately 227 million ounces of silver sold short, 3 times more than the vault contains. When a delivery cycle opens with this level of physical demand against this depleted vault, the shorts face a binary choice. Deliver metal they may not have, or push the paper price lower to discourage additional delivery demands and shake out weak hands who might stand for delivery but would reconsider if they see the price dropping. The smash is not about sentiment. It is not about technical analysis. It is a tactical move designed to reduce physical delivery pressure on a vault that cannot sustain another month of record demands. The timing window is specific because it has to be. Between 9:45 and 10:45 a.m. Eastern is when COMEX volume reaches its deepest liquidity pool. Enough resting orders exist on both sides to absorb a large, concentrated short block without the move looking obviously manipulated. A block of paper short contracts hits the bid simultaneously. The price drops $1 to $3 in minutes. Algorithmic stop losses on leveraged long positions trigger. The stop loss cascade pushes the price another $1 to $2 lower. Retail traders see the red candle and panic. They start selling into the move. Financial media writes silver selling off amid weak sentiment. The banks cover their newly placed shorts at the lower price within hours or days. The cycle is complete. They profited from the round trip. You lost money. And the delivery pressure on the vault eased because some long holders who were planning to demand delivery saw the price drop and changed their minds. JPMorgan paid $920 million in 2020, settling DOJ charges for doing exactly this, spoofing, placing large orders intended to manipulate prices. Individual traders were criminally charged. Guilty pleas entered. Federal court records document the mechanism. It is not theory, it is legal history. And the fine was paid from a fraction of the profits the strategy generated over years. Now, here's why April 1st specifically is their best opportunity in weeks. 4 factors converge today that make the smash window wider and more effective than usual. Factor 1, it is literally April Fool's Day. Any unusual price movement today gets dismissed by casual observers as noise. Headlines about silver dropping on April Fool's Day get less attention than the same drop on any other day. The calendar provides psychological cover for the move. Factor 2, Q2 just started yesterday. Fresh quarterly capital allocations are beginning to flow into markets, but institutional capital deployment takes days, not hours. The new Q2 money is being allocated right now, but has not fully entered the silver market yet. There is a 24 to 48 hour gap between the start of a new quarter and the arrival of fresh institutional buying. That gap creates a window of reduced buying pressure that makes the smash more effective. Factor 3, ADP private payrolls data dropped this morning at 8:15 a.m. Eastern. Any employment data creates short-term uncertainty. Uncertainty reduces buyer conviction. Reduced conviction makes the price easier to push lower. Whether ADP beats or misses, the data release creates a 30 to 60-minute window of digestion where market participants are processing the number instead of placing orders. The smash can ride the data uncertainty for additional momentum. Factor 4. The Liberation Day tariff announcement is expected tomorrow, April 2nd. Markets pre-position for major policy events 24 to 48 hours before the announcement. But pre-positioning creates two-way flow as some traders bet on escalation and others bet on de-escalation. That two-way uncertainty further reduces the directional conviction that would normally push back against a concentrated short block. The banks get cleaner execution on their smash when the market is uncertain about tomorrow's tariff news. Now here's the critical part. What happens after the trick? Because the data on this is overwhelming, and it is the reason I titled this video the way I did. The real move comes after the joke. In October 2025, around first notice day, the pre-FND smash dropped silver 3.2% in the 10:15 to 10:45 a.m. window. Silver recovered fully within 48 hours. In November, the smash dropped silver 4.1% at 10:23 a.m. Full recovery within 72 hours. In December, a 2.8% smash between 9:58 and 10:30. Full recovery within 24 hours. In January, the smash attempted at 9:45 a.m. dropped silver 1.2%, but then failed catastrophically. Silver reversed and exploded 22% higher as the shorts got trapped in a squeeze. In February, the CME halted all metals trading on February 25th, 48 hours before March FND. Silver dropped during the halt period but recovered post-halt. In March, the smash was distributed across multiple sessions, producing a 14% decline over 3 weeks, the deepest and most prolonged smash attempt in the sequence. Partial recovery is still underway. 6 FND windows, 6 smash attempts. 4 produced full recoveries within 72 hours. 1 triggered a short squeeze that sent silver 22% higher. 1 produced a deeper multi-week decline that is still recovering. The recovery rate on FND smashes is 83% within 72 hours. And the one instance where the smash failed entirely produced the most profitable outcome for holders, a 22% gain. The expected value calculation is straightforward. If you hold through a smash, 83% of the time you recover within 3 days. 17% of the time you experience a deeper decline that takes longer to recover. But even in the worst case, the March multi-week decline, silver has recovered from 65 back to 75 in the weeks following. If you sell into the smash, you lock in the manufactured loss. You sell at the artificial low, and then you watch the recovery happen without you. The expected value of holding through the smash is dramatically higher than the expected value of selling into it. But here is what makes April's post-trick setup more powerful than any previous month. The conditions that exist right now for a recovery move are the strongest they have been all year. Q2 fresh capital is entering the market. The window dressing and a redemption selling that suppressed Q1 prices is gone. Fund managers are deploying new allocations. Historical seasonal data shows April through June as silver's strongest quarter. The post-quarter end reallocation cycle creates institutional buying pressure that did not exist during previous FND smash recoveries. The QT structure has fundamentally shifted. StoneX confirmed that managed money net long positioning may have formed a trough 4 weeks ago. 13-year lows in speculative longs. The selling is exhausted. Large speculators showed the first increase in both longs and shorts in months, a subtle shift in sentiment per StoneX's analysis. When the speculative community is at rock bottom and begins to turn, the buying pressure they create meets minimal overhead resistance because there are virtually no speculative sellers above current price. 8,500 contracts long versus 60,000 at previous peaks. The path above current price is clear. Shanghai silver surged 652 yuan in a single session this week. $79 to $81 equivalents, $8 to $12 above COMEX. The sustained premium above $8 for 3 consecutive weeks has preceded COMEX, following higher within 3 to 6 weeks, in every historical instance documented in 2020, 2022, and 2025. Shanghai is not just suggesting higher prices. Shanghai is trading at higher prices right now. The convergence window is active. The COMEX delivery data from March was historic. 52.63 million ounces demanded, 61% claim rate, the highest 2-month delivery rate in exchange history across February and March combined. The vault has been tested, and it passed, but barely. Each month costs more metal. The coverage ratio drops further. The September Vault 0 timeline continues its countdown. Every delivery cycle that the system survives weakens it for the next one. April's delivery demands, even at the initial 9.9 million ounce standing level, apply additional stress to a vault that has no margin left. The EFP escape valve is weakening. Banks are offering cash premiums to long holders to avoid physical delivery. But industrial buyers, the ones who actually need silver for production, are increasingly refusing. Samsung locked up mine output directly because they do not trust exchange delivery. Solar manufacturers need 240 million ounces annually. AI data centers growing silver consumption 15% year over year. These buyers cannot run factories with cash settlements. They need metal. Every industrial buyer who refuses an EFP and demands physical delivery adds pressure that the vault cannot deflect. The fundamental backdrop has not changed by a single metric since the all-time high. The Silver Institute's sixth consecutive deficit year at 67 million ounces, no new mine supply until 2033, 70% byproduct production, Mexico cartel disruption in 28% of global supply, China export controls, LBMA vaults down 40% since 2021, CNN reporting industrial metal inflation from AI expansion. Every fundamental driver that supported $121 silver in January is still present at $75 silver in April. The price changed. The fundamentals did not. JPMorgan targets 81 average for 2026, Goldman 85 to 100, Citi 110, Bank of America 135 to 309. The bank's own research departments are publishing targets 12 to 300% above current price, while their trading desks execute smash operations to push the price lower. The research desk and the trading desk cannot both be right. Either silver is going to 81 plus, as the research says, or it is going lower, as the trading desk's short position implies. The research is public. The short position is documented in CFTC filings. The contradiction is visible to anyone willing to look. The Iran deadline is 5 days away. Trump postponed strikes for 5 days after productive talks. Any de-escalation weakens the dollar's safe haven bid and lifts silver. Any escalation spikes oil and inflation, which also supports silver through the precious metals inflation hedge. Silver benefits from both outcomes. De-escalation weakens the dollar. Escalation drives inflation. Both are silver positive. The Iran variable is asymmetrically bullish regardless of direction. Goldman recession probability, 35%. Moody's, 49%. February NFP showed 92,000 jobs lost. Every recession in modern history has been followed by precious metals outperformance. The 2020 recession produced a 142% silver rally in 4 months. If Moody's 49% probability materializes, the historical precedent says silver does not just reach 100. It exceeds 100 on the same timeline that produced the $29 peak in 2220, scaled up to today's starting price. Brent crude above 100 after the 58% March surge creates a persistent inflation floor under precious metals. The Fed is trapped between inflation and recession. They cannot cut because oil is above 100. They cannot hike because the economy is losing jobs. That monetary policy paralysis means the dollar has no clear direction from the Fed, leaving physical supply demand as the dominant silver price driver. And the physical supply demand data is the most bullish in the metal's modern history. The VIX above 31 means volatility is elevated. Elevated volatility amplifies moves in both directions. If today's smash pushes silver down $2, the recovery move is likely to be $3 to $4, as the compressed volatility springs in the opposite direction. The Bollinger Band compression on the daily chart confirms this setup. Compressed bands precede explosive directional moves. The smash compresses the bands further. The recovery explodes through them. Friday's non-farm payrolls drops into a market closed for Good Friday. The Iran deadline arrives Sunday. Monday, April 7th, opens with everything compressed into one session. The most volatile silver open of 2026 is 7 days away. If the banks smash silver today and you sell, you exit the market 6 days before the most catalyst-loaded session of the year. You give up your position right before the event that could move silver $5 to $10 in a single session. The timing could not be worse. The banks are counting on one thing today. They're counting on you reacting emotionally to a manufactured red candle instead of responding rationally to the data. They are counting on you seeing a $2 drop at 10 a.m. and thinking the crash is resuming instead of recognizing the pattern that has repeated 6 consecutive times. They're counting on your fear being stronger than your analysis. They're counting on you being the April Fool. Do not be the joke. Be the person who understands the joke and refuses to fall for it. The smash is the trick. The recovery is the real move. The data says 83% recovery rate within 72 hours. The fundamentals say every institutional target is above current price. The COT says the speculative trough is in. The Shanghai Premium says physical reality is $10 to $12 higher. The vault says 76 million and falling. The deficit says 6th consecutive year at 67 million ounces. The trick comes first. The real move comes after. And the real move is up. Not because I want it to be, not because I hold silver, but because every verifiable data point from every credible source across every relevant market on the planet says the paper price at $72 to $75 is below physical reality, below institutional targets, below Eastern exchange pricing, and below the fair value implied by 6 years of structural deficit. Let them play their April Fool's Day joke. Let them have their manufactured red candle. Let them write their headlines about silver selling off. And then watch what happens. Thursday, Friday, next week, next month. When the trick wears off and the fundamentals take over, the real move comes after the joke. It always does. Stack accordingly. I will see you in the next video.